Section A of AFM March 2020 paper. So this is the first question and this is the third part of the video. I have discussed question 2 and 3. So if you haven't seen my video where I have discussed question 2 and 3, you can check out the videos. So now let's go to this section A, and I always recommend that you start your AFM paper with section A because it carries 50 marks. Because if you're planning to do this at the end, then you are putting yourself at a risk, because usually towards the end our performance level goes down. Okay, we are not able to perform that well because we are also under time pressure, because our aim is just to finish the paper somehow. But when you start this paper, your mind is fresh. That time you'll be able to concentrate more, you'll be able to take more information, retain more information, because section A case study is usually 2 page or 3 page, it's long, so it needs more attention. You need to be fresh, you need to be highly energetic. Whereas section B, the 2 questions in section B 2 and 3, they're small, so you can take them towards the end, right? Even if you're having a lower energy, you still can perform those 2 because you have less information to retain there. Whereas section A is a long, huge ones. You have to spend more time here. You have to spend 90 minutes in your section A, whereas in your section B, question 2 and question 3, 45 minutes each, right? But again, the decision is yours. You are free to choose in any order the way you want to do the question. You can start from section B also, there is no harm. But the best way of tackling this paper, I would say, is section A, right? So now let's start with the introduction. This question is on the topic from accusation, right? Mergers and accusation. That is your section C, right? And this question is performed poorly compared to the other questions. Like question 2 was about exchange rate and question 3 was about net present value. This section is performed more worse. That's because we don't pay so much of attention to accusation and mergers. There are so many things to go through, right? There is and also you have to know how to start in a mergers and accusation question. The main problem is candidates, you don't know how to start a question, like what are the workings you have to start with. But like in net present value calculations, you start with sales, revenue, cost, all this cash flow, your discount, and get the net present value. We all know that. Even in exchange rate, we know what to do. Under forward, we convert. Futures, we know what to do. Options, we know the standard. But mergers and acquisitions is not standard. But still, there are some techniques there as well, which you need to know, so that when you come to mergers and acquisitions, you can follow how to proceed, right? But it's not standard, right? It's not standard like the other 2 questions. It varies. The answer you provide will vary. But still, more or less, the main idea of accusation is you have to know to calculate the synergy values, right? The combined value, the combined cost of capital. You need to find the values of the 2 companies separately. So these are the whole main idea of accusation. These are the things which you'll be told to calculate, and also the premium, how the premium is calculated, how an accusation is going to be financed. So these are the few things which you will be asked to do, and even in this question you have been asked to do all of this. The good thing about this question paper is this section, all the things are included in one question. All these things you have to calculate: cost of capital of the combined company, you have to calculate how the gearing will change because of accusation, you have to know the benefit, the premium, everything is included in this one whole question. So make sure that you attempt this question, so that it will help you to know how accusation and merger question you have to proceed. So now let's start with the introduction, right? Or you can go and read the requirements also. Let's read the requirements first. As you can see, it's going to 2 page, right? Let's read the requirements first. So the first requirement says discuss the behavioral factors which may have led to business such as smart drivers, tech being valued highly. So you can see that it's a tech company which has been valued highly. Now you have to discuss the behavioral factors. This is purely theory. Right? Let me underline. Always you have to underline the keywords. And it's for 6 marks. Right? So this is how you have to start in this question. It's for 6 marks, right? So you can write 2 points, 2 behavioral factors and explain. Or you can have 3 behavioral factors and explain. You'll be getting 2 marks, right? 1 mark for identifying the factor, 1 mark for explaining that factor. So like that you can give 3 points, and for explaining those 3 points, right, 3 into 2, or you can give 6 different behavioral factors, 6 points, right? But if you cannot come up with 6 points, right, because most of you are not, you will not be able to come with 6 different behavioral factors, right? So in that condition, you can, what you can do is you can select 3 behavioral factors and explain those 3, right? So 3 into 2, you'll be getting the 6 marks, right? So this is the way you always have to see the marks and decide how many points you have to write. This is your strategy. Number 1, see the marks and then decide how many points to write. Sometimes you might be having so much to write, but if the marks is for 4 marks or 2 marks, it's not worth writing so much, right? Now let's go to part B. Part B is your main thing because your professional marks is in part B, right? Prepare a report for the board of directors of West Parley Company Which. So it's a report again, right? You have to know the format of report, right? I have made a video also on this, which I'll be sharing with, which I'll be uploading after my live, right? It's for SBL, but you can also use it for AFM, right? For the purpose of SBL, I have prepared the formats of all reports and press release and all those things, presentation, how the format should go and all. It will be uploaded right after my live, which is on 1st of December. So that format you can use for AFM as well, right? Because the report format is same, right? The subject doesn't matter, the paper doesn't matter. So now you have to prepare a report. Most of the time it is report in AFM which you have to prepare, right? So the first part in all, okay, under this report, all these 4 points have to be there. The first point, compare the additional value which West Parley Company believes can be generated from the sale of Matt Raver's tech based on the PE ratio with that of the projected present value of his future free cash flows. So you have to find the difference, right? Additional value which can be generated from the sale of tech based on PE ratio with that of the projected present value of his future free cash flows, right? It is for 4 marks. Now let's go to the second one. Calculate the weighted average cost of capital for the combined company, right? So weighted average cost of capital for combined company. You need to calculate this calculation. Third, estimate the total value which West Parley Company shareholders will gain from the acquisition of Matt Raver's company. So the total value which West Parley Company shareholders will gain. That means West Parley is the one who is going to acquire and Matt Raver is the target company, right? So total value West Company shareholders will gain from acquisition. And the fourth one, assess the strategic and the financial value to West Parley of the acquisition. 2 things you have to talk about: strategic, financial value. To whom? To West Company, including a discussion of estimations and assumptions made. So your estimations has to be there, your assumptions has to be there. Even if the question does not tell you to mention, most of the time they will give this line, include assumptions. Even if they don't give, still you include assumptions because you will be getting marks for those assumptions, right? And now professional marks will be awarded in part B for the format, for the structure, and for the presentation of the report, right? And mind you, when you are writing a report, all this one, right? This one, it has to follow in that order only. Your report has to be in that order only. You cannot write the fourth one in the first paragraph, your second one in the last paragraph. You cannot jumble the order. The order has to be maintained. Your report should start with the additional value first, then the second you have to calculate the WACC, third you have to the total value, and the last strategic and the financial value, right? But since the first three, if you are seeing, they are calculations. So calculations you can put under appendix, right? And only your final answer will be included in the report. Inside the report, you will not do any working. Your working has to be separate outside of the report or as an appendix to the report, right? And finally, part C. Part C is not included in part B. It does not come inside that report. It's a separate, right? Only part B is for the report part. So part C is a different. So discuss the factors which may determine how the offer for Met Rivers will be financed and hence level of gearing which West Parley Company will have. So there are two things. How the offer for this one will be financed. You have to discuss the factors which determine how, if you want to acquire a company, how you're going to finance the accusation. What are the factors? Number one, you have to talk about that. Number two, hence the level of gearing. So level of gearing, how the level of gearing will change. You need to talk about it. Whenever accusation comes into place, gearing also comes into place because your cost of capital will change, your WACC will change, everything will change, right? And it's for 50 marks. That means how many minutes? 50 into 1.8. Okay, 90 minutes. Let me write it here. 90 minutes you have to spend here. So make sure that first time you open the paper, right? It's a 3 hour 15 minutes paper. So the first 15 minutes you spend the time reading the case study in section A, right? And the rest 90 minutes, right? Rest 90 minutes you are writing on answering the section A. So first 15 minutes which you are taking, make sure that you go through all the requirements. Just briefly read all the requirements of section A, B and C and then read the case study. Or just, if you want to focus just on section A, no need to go to section B and C, that you can read it later. Just go to the case study in those 15 minutes. So how you spend your 15 minutes, additional 15 minutes you are getting, right? Other than 3 hours. So that 15 minutes, how you spend is up to you. But use it effectively, because if you use it effectively, you are saving time in writing answer. Otherwise, you will struggle very badly to come up with an answer. Your planning, everything has to be done in your mind first. Everything has to come in your mind, how my report will look like, how it will go, what are the things I have to include. Then only you will start answering. If those things does not come in your mind, then you cannot write a report. Don't do that mistake of writing and then thinking, what will I write? And then keep cutting, writing, cutting, erasing, cutting, writing. Don't do this. You will lose your professional marks, right? So don't do those. Plan beforehand and then write an answer. That's why practice writing report, practice all these questions, so that when you come to the exam, you already know how the report looks like, how it will go. You need practice. Day one immediately will not come in your mind, right? Because if you go to the exam hall without attempting at least one past paper, like I never recommend just one, at least 3 to 4 past papers you should be attempting, but at least one you should go through, rather than just going without even looking at the past paper, without trying past paper, just going to the exam hall and thinking that I know everything, I've studied everything, I will take this exam. It will not work out. So don't do that mistake. Now let's go to the case, and only will read the part which is relevant for section A, behavioral factors. Why this industry is being valued highly. Only for that section will read. Right? So all this will not read because it is section A, means it will come in the beginning of the case. Because I told you there's an order of the requirement and the case study. So now let's read the introduction, right? Wherever you feel is relevant to highlight, you have to highlight. So introduction is West Parley Company is a listed retailer. Okay. What industry it is in? It is a listed retailer. Very important to note whether it's listed or unlisted, because your PE ratio will change based on listed or unlisted, right? And it's a retailer. What is the main line of its business? Mainly selling food and small household goods. Again, I'm underlining this. Selling food and small household goods. So that is the main business of West Parley, right? It has outperformed its competitors. It has outperformed its competitors over the last few years as a result of providing high quality products at reasonable prices, and also has having a stronger presence online. Good. Looks good, right? It has kept a control on cost, partly by avoiding operating large stores on expensive city center sites. Instead, it has had smaller stores on the edge of the cities and towns, and a limited number of larger stores on convenient out of town sites, aiming at customers who want their journeys to shop to be quick. Right? So one of its advertising slogans has been, "We are where you want us to be." Okay, we'll highlight this also. Maybe we need this piece of information. Whenever you are given this kind of slogans and mission statement or advertisement or something like that, please highlight it, because you will be needing this slogan somewhere in your answer. Like, you can make a good use of it because they are claiming to be where the customer is. Now let's read the second paragraph. West Parley's company's share price has recently performed better than that most companies in the retail sector generally. Share prices in the retail sector have been relatively low as a result of poor results due to high competition, large fixed cost base, and high interest rates. The exceptions has been shares in retailers specializing in computer and high technology goods. This shares appears to have benefited from a boom generally in share prices of high technology companies. Some analysts believe share prices of many companies in the high technology sector are significantly higher than a rational analysis of their future prospects would indicate. Matt Rivers Company, right? Okay, we don't need to read about the two types of stores, because our main focus is why tech industries retailers are valued highly. That's it. So the other piece of information we don't need, right? So we'll read here. Okay, we'll read that part because we need about the tag, right? So Matt Rivers Company, right? So Company has identified the listed retailer as an acquisition target because it believes that Matt Rivers Company shares are currently undervalued, and part of Matt Rivers Company's operations would be a good strategic fit for West Parley Company. They operate two types of store. One is Matt Rivers Home and the other one is Matt Rivers Tech, right? So Matt Rivers Home, they mainly sells larger household items and home furnishing. This type of retailers have performed particularly badly recently, and one major competitor of the Matt River has just gone out of business. And Matt Rivers operates a number of city center sites, right? But as a much higher proportion of out of the town size than its competitors. Now let's read about that tech. All these numbers calculations you don't have to read because you don't need any numbers. You only need theory, right? So what is it about? Matt River Tech sells computers and mobile phones in much smaller outlets than those of Matt River's Home. So that's it. Now let's go and see how the answer is presented. So the answer has been presented. It has been for 8, right? 6 points, right? So 6 marks. So they are explaining 2 points. Okay, one is for individual business and the other one is from the sector. right? So now individual business will see what they have said. Okay. A number of behavioral factors to do with the individual company, that means the Matt Trevor company only, as well as the sector as a whole, may lead to Matt Trevor's stake being valued higher than appears to be warranted by rational analysis of his future prospects. One possible factor, right? So this line, if you see this first line itself, they have taken for the requirement from the case study itself. They're saying that there are some number of factors why it is valued high. So that is the first line. Now, one possible factor is the asking price. I'm highlighting all the factors. So one factor is asking price. Why it is valued highly, even if it is not a fair price, may provide a reference point which significantly influences the purchase valuation of the business. Right? So suppose an asking price of a company is $200, right? Even if it is not fair, even if it is valued highly, still that $200 will be used as a reference point for the one who is purchasing, right? The company, for the purchaser. That is how they are going to value that business. So if that asking price itself is too high, of course that company, that industry will be valued too high. Tech industry especially. Right? Now let's read the second paragraph. The fact that Matt Trevor's tech is available for purchasing may help raise his price. Right? This industry is available for purchase, right? The tech, it may help raise its price. Purchasers may see this as a rare opportunity to buy an attractive business in this retail sector. Exactly. What happens because of this? This will be made more likely if investors have loss aversion bias. A desire to buy the tech now because otherwise the opportunity will be lost. This is known as loss aversion bias. You don't want to lose an opportunity. Just because an opportunity is there, you want to buy it. Even if it's high, even if the price is valued high, you will buy it because you will miss this opportunity. You have a fear of missing an opportunity. That is known as loss aversion bias. Matt Trevor's tech being offered for sale will mean that information about the company, showing it in a positive light, will be available for purchasers. This could result in availability bias. Investors taking particular note of this information because they can obtain, right? They can readily obtain it rather than the information which may be difficult or costly to find. Now let's go to the sector wise. By the way, all this theory part, availability bias, loss aversion bias, asking, all this theory part, the knowledge part is taken from the textbook only. There is nothing new. So if you are in a doubt where this information is taken from, it is taken from the textbook. That's why going through the theory part from your textbook is very important. It's necessary for you to write a theory on marks. Sector. Now let's read the sector part. The first paragraph is saying that there are a number of possible behavioral reasons why share price in this sector appear generally higher than the rational analysis indicates. One is the herd instinct. Right? It means you are following the crowd. Whatever the crowd is doing, you are doing it. Thinking that they are right, right? So investing in the sector because other investors has also been buying shares, not wishing to make judgments independently of other investors. You don't want to take the risk of being the odd one out. So if you see that many shareholders, many investors are buying shares in that tech company, you also will be following the crowd. You also will be buying shares because you're thinking that they are right, right? So that is known as herd instinct. Okay. The herd instinct may be generated by previous share price movements. Investors may believe once price starts rising in the sector, they will continue to do so indefinitely. So once the share price rise, they always believe the share price will keep rising only, right? Now, following fashion may also be a factor. Fashion, right? So following fashion may also be a factor. Fund managers who wish to give impression that they're actively managing their portfolio by making regular changes to it may have a preference for companies which appear up to date and are currently popular. Okay, so this may be linked to an expectation that sales of technological advanced goods are likely to generate high returns, right? So you should have some knowledge of how a high technology industry perform to write all these points like herd instinct, availability bias, loss aversion bias. All these are generally they have been explained in the textbook, but when you write in an answer, right, relating it to a case study. So this is a high tech industry. So based on that, you have to come up with an answer, make a structured answer. How and her instinct will be, what will be the fashion in the technology industry. You have to have little uh, knowledge of this, right? And there is also a confirmation bias. The idea that the investors will pay attention to evidence which confirms their views that the sector is good one in which to invest and ignore evidence which contradicts their belief. So we always, right, as a human, we always want to believe in those kind of information or those evidence only we see which confirms with our decision, right? Even if you're wrong, you don't accept it. You will not look at those evidence which goes against your beliefs. You want to somehow prove that your decision is the right one, so you always care about those evidence which confirms, right, which goes with you, which is in favor of you. And if something is against you, you don't even look at it, you ignore those evidence. So that is known as confirmation bias. In the past, technology companies have been valued using methods which support the beliefs of investors that they have high value. So how technology companies has been valued in the past? Or using methods which support the beliefs of investors that they have high value. So investors believe that they are of high value. That's how they value. Rather than traditional methods, yes. So technology industry is not being valued by traditional methods, how you value the other industries. Technology industries is valued using the beliefs of the investors. This is something which is not there in your textbook and you will not come across while you're studying. This is something which you have to think. That's why you have to know more knowledge, right, of how an industry works. And so having any detail about an industry, how it works and all, will give you an additional advantage to come up with such answer, right? That how a technology industry is valued, all those things is not there in the book, right? It's not from the traditional methods but from the belief of investors. This is something which is out of your own thinking, right? So this is not from the book, right? Such as cash flow analysis. You cannot value a tech industry using cash flow analysis, which suggests a lower business value is more realistic, right? Why lower business value is more realistic? Because lower business value is being valued using traditional methods, such as cash flow analysis. You have some objective analysis. But what about the belief of investors? It keeps changing, right? It's not objective, it is subjective. So even the technology industry, even if it's valued highly, it is subjective, it is not objective. So that's it. These are the behavioral factors. Make sure that you know what is behavioral finance and behavioral factor. Now let's go to the second requirement. So first requirement is over. Second requirement is about the report which you have to make. Yes. So your attention has to be 100%. You have to be very focused now. Okay. So prepare report. Okay. First part we are doing, compare the additional value which Westpay will believe can be generated from the sale of the tech based on the PE ratio with that of the projected present value of its future free cash flows. Let's go to that part. We don't need all this, right? We only need this piece of information from here till here. Only this piece of information is needed for the first one because the rest all is for the next one, As you can see, the next paragraph is post acquisition cost of capital. It is very clear that it's for the next requirement. You don't need it for this requirement, and it's only for 4 marks, right? So, okay, they sell computer and mobile phone. Okay, extracts from the latest annual report is given. Pre-tax profit. Okay, and just check, all these are in millions. You always have to check this part, whether it's in millions, is in thousands, right? So pre-tax profit is given, long-term loan is given, share capital is given. Okay, the share of pre-tax profit between Matravers Home and Matravers Tech was 80-20, right? Pre-tax profit, Matravers Home, Matravers Tech is 80 and 20. 80% goes to home and 20% goes to tech. The current of this, right, of this value. The current market value of the share, Matravers share, is 12,500 million. Here they are not dividing between the tech and the home. They are saying the whole of the Matravers company's share. Current market value is this. Right? And its debt is currently trading at its book value. They believe, Westphal believe that it will have to pay a premium of 15% to Matravers shareholders to buy the company. So now let's go red. Westphal intends to take advantage of the current values attributed to the business, such as the tech, by selling this part of the Matravers company at the relevant sector price earnings ratio of 18. So the sector PE ratio is 18. You're selling at this PE ratio rather than a focused estimate of the tech's present value for the future free cash flow. So they have already given you the present value of the future free cash flow. Right? So they have already given you the presented free cash flow, which is 4,500. Your job is only to find using PE ratio, and you want to find the excess. What is the difference between that present value and using PE ratio, right? And the company's tax rate for both companies is 28% per year. So tax is 28%. Using this piece of information, you'll be able to calculate. Now, what we have to is how to start this question. That is the question you must be having, right? How to start this? You know the workings are there. You know how the answer is. But the thing is how to know from where to start. Okay. What is the question asking you? You have to find using PE ratio, right? The value using PE ratio of selling this part. So to find the PE, you have been given the PE ratio, price earning ratio, right? Is 18. So you have the PE ratio of 18. What you need is earnings. You need the earnings to multiply by 18 by the PE ratio, right? Let me write here. Earnings multiply by PE ratio to get the value. So you already have the PE ratio. You have to find the earning. Earning is the one which you have to find here. How will you find the earning? By using this piece of information, right? You have to start with the profit, pre-tax or post-tax, right? You will be given the profit. Here it's pre-tax, so you have to adjust for tax, right? So you have to start with the profit first. Whenever PE ratio is given, you have to start with the profit because you have to find the earnings. Your job is to first find the earnings. To find the earnings, you have to start from where? Pre-tax profit. So just do that, pre-tax profit, right? You have to take 20% of 1950. Why 20%? Okay, you have to take 20% because only of that you want to know the tech industry you're selling, right? Only for that part value you want to know how much value you are getting from selling the tech industry, how much profit. So you only want to find out of this 20% only, not the whole thing. So first find 20% of 1950. That is pre-tax. Then you have to take after tax. Let's see how the answer has been formed. Okay, When you come to B, you will be seeing that this is the report, this is the format. It has been divided into strategic fit, financial aspects, synergies, and this is the introduction, right? And the current home business, their sell and other assumptions, right? So this is the whole report, and finally the conclusion. So in this report, you are not going to give any workings. Your working has to be after this report. So we'll go more down. Right? So just start from here. From here onwards, your duty starts from here. Take a fresh page, start working. Right? A report compiled by date. Appendix 1. Put all your working under appendix. Don't include in the main part of the report. Appendix 1, because this is the first thing we are calculating, so you will name it as Appendix 1. You have to give a heading for Appendix 1. Just don't write Appendix 1 and start working. What is Appendix 1? Okay, so this Appendix 1 is this. Put a heading for Appendix 1. Is it so difficult? No, it isn't very difficult. Everything is given in the requirement. From the requirement itself, we can take the wordings. Estimate of additional value created from sell-off. So you are selling, and what is the value of selling that? So now first line. I'm going line by line. Okay. 1, 2, 3, 4. Let me put the number like this. Right. So first, share of pre-tax profit. 20% of you are taking of the pre-tax profit. After this, you are taking after-tax profit. Tax is 28%, right? So that's why that multiply by 0.72 or 1 minus 0.28. You are getting this. Go to the third step. Proceed from the sale of based on PE ratio. Now, this is your earnings. You have the earnings. You have the profit. Earnings, profit, whatever you can call it. You have the profit. Start with pre-tax profit. Find after-tax profit. Then that profit only you have to multiply by the PE ratio. So now you have and multiply that by 18 to get the proceed. Right? So this is your proceed. What was your proceed using the free cash flow? The present value of using free cash flow is given in the requirement in the case study as 4,500. So just see you are getting what is the excess value. That's the difference between the proceeds from PE ratio and the present value from the free cash flow, which is this. So this is your excess value. That's it. You have already found it. You don't have to explain anything because it's only for 4 marks and it's calculation. You have to estimate. They didn't tell you to discuss anything. So when they tell you to estimate, calculate, you only have to calculate. You don't have to explain. But when the wordings are like explain, calculate and explain, discuss, then you have to write. Okay, so here you don't have to write anything, only this thing. I hope you can follow this way. Pre-tax, then after tax, then multiply by PE ratio, then you will get the value. Right? So that part is over. Now let's go to the second requirement. Right? Second, calculate the weighted average cost of capital for the combined company WACC. Very interesting. This is the part where you have to do majority of your work. What comes to your mind when you think of WACC? Let me ask this question before I start. Right? WACC. WACC includes cost of capital, cost of equity, and cost of debt. Together makes WACC. Right? So that means you have to find the cost of equity, cost of debt. Right? So now you can proceed. You know what you have to find out. Now let's start. What is the relevant section for this? The relevant section, they will be using heading, so only this part is relevant for you. For post-acquisition cost of capital. Now, let's read. The post-acquisition cost of capital of the combined company will be based on its cost of equity and cost of debt. Okay. Even if they don't mention, it's common sense. We know that. So the asset beta post-acquisition can be assumed to both companies. Now this is very important. Okay, so the asset beta post-acquisition can be assumed to be both companies' asset betas weighted in proportion to their current market value of equity, right? What is asset beta post accusation? After accusation, what is the asset beta? Right? So the asset beta can be assumed, it is assumption, to both companies' asset beta weighted in proportion, okay? Weighted in proportion to their current market value of equity. So this is how you have to use the assumption they is giving, right? The asset beta of the combined company is the asset beta weighted in proportion to their market value of equity of both the companies. Okay. Now let's go to the second para. Westpale has 4,000 million $1 shares in issue, currently trading at 8.5. Trading at 8.5. That is the equity part. It has 26,000 million debt in issue, currently trading at 105 per 100 nominal value. That means it's trading at premium. You can see, right? Its equity beta is 1.02. So you have been given the debt. It has been trading at this, and equity beta is 1.02. Equity beta has been given so that you can calculate the asset beta whenever, right? You will be given either one. Either the asset beta will be given to you so that you find the equity beta, either the equity beta will be given to you to find the asset beta. So you will be given one of them and you have to know how to find, right? And the Matt Travis company's asset beta is 0.75. Very important. You need the asset beta of both the company. You already have a one company, the other one you have to calculate. Westpale's company's asset beta you have to calculate because you have been given the equity beta of Westpale. When you interpret also, you have to interpret like this, right? When you're underlining itself, you have to question yourself, what am I doing? You have to follow through, right? Not when you come to the calculation, you have to think, oh, what should I do? Where should I start? No, while you're underlining, while you're reading the passage, reading the case study, there itself you have to think, pause and think, what am I doing? What should I find out? Or you can make a note somewhere. I have to find cost of capital, cost of equity, cost of debt, right? So don't go and find the asset beta, right, of both the company. Don't waste unnecessary time. Asset beta is given here of one company. Only the other company's asset beta you have to find out. How you will find out? Using this equity beta. The current market value of Matt Travis company share is 12,500 million and its long-term loan is currently trading at its book value of 6,500 million. So current market value of shares this one and long-term loan is at this. Now the risk-free rate of return, yes, you'll be given such a risk-free rate and risk premium will be given because you have to find the cost of equity using capital asset pricing model. So the risk-free rate is 3.5% and market risk premium is 8%. You have to find the cost of equity to use the CAPM. The pre-tax cost of debt of the combined company is expected to be 9.8%. Mark, always be sure whether it's post-tax or pre-tax. Don't just assume every time you're going through pre-tax, okay, it will sometimes they will be giving you post-tax. Tax has already been adjusted. So don't go and again adjust tax there. Just because tax is given, you have to adjust, right? Read it, whether it's pre-tax or post-tax, pre-tax or post-tax. Pre-tax, adjust tax. Post-tax, keep quiet. Okay, so pre-tax cost of debt of the combined company. Which company? Combined company, not individual company, combined company, is expected to be 9.8%. It can be assumed that the debt equity ratio of the combined company will be the same as the Westpale company's current debt to equity ratio in the market values. Debt equity ratio of combined company same as Westpale, current debt and equity market value. Very important because you don't know the debt ratio of combined company, right? And combined companies debt equity ratio changes. Most of the time it will be changing, but in this case, for simplicity, for the calculation, they are assuming that it's the same as the West Parle company's current debt to equity ratio. So suppose if the West Parle company's debt to equity ratio is 2080, that means combined companies debt to equity ratio is also 2080. That's what it means. And the company paid tax rate for both companies is 28%, right? We have already know that. Okay, so now how to start? How to start? Let's see how the answer is presented. I'm not going to see the report also now, not going to touch the report. I'm just going to the appendix, going through the working. Once you are done with all the appendix, once you are done with all the works, then you will go and start writing that report. It's not just you start writing one appendix, again you are writing in the report, again you are writing appendix 2, again you are writing in the report. Don't do this. Make all the calculation under one, calculate, because calculation does not take so much of time. Quickly finish all the calculation, and then you can aram se nicely you can spend your quality time writing. Beautifully you can write if time is there, but calculation doesn't take so much of time. You can do it that whenever calculation and theory is given, always first do the calculation and then write. Okay, so appendix of the combined appendix 2. Okay, this is appendix 2. Appendix 2, the name has been given as estimate of the combined company's cost of capital. Always name your appendix, so that is very easy for you to relate in the report. Okay, so asset beta has been given already at 0.75, right? So what you have to do now, the next step is very simple. One company's asset beta is given, you have to obviously find the next company's asset beta. So it's very clear, you have to do West Parle's asset beta. You have to work on West Parle company's asset beta. How will you start? Right? It's very simple. When you have to find a company's asset beta, right? Three things only you need. You need the market value of equity, you need the market value of debt, you need the cost of equity. If these three things are there, you can find the asset beta. And all these three things are there for the West Parle. Right? I will write it somewhere. I will write it here. Or okay, I will write it here. I will put an arrow so that you know it is for first, second, third. Market value of equity. Market value of debt. Make this notes for your future reference so that you don't keep forgetting. It's very confusing where to start, okay? And then equity beta. All these three things are there. You can find the asset beta. So let's first start with, okay, here they have presented with market value of debt, right? So market value of debt has been at 26,000, right? Into 1.05 because it is 105 divided by 100. Nominal is 100 and it has been trading at 105, right? So 105 divided by 100 is 1.05. They didn't show the breakup of how 1.05 came, but you show it, right? 105 divided by 100 multiplied by 26,000. That is your market value of debt. Don't take the book value of debt. Your book value of debt is 26,000, right? You have to find the market value. When you are given the book value, you always have to find the market. You cannot work in two different things. For example, suppose you are given the market value of equity and you are working with the book value of debt. So it cannot be market value of equity and book value of debt. Both has to be book value or both has to be market value. But both has to be in the same thing. It cannot be in two different things. Okay. So market value of debt and market value of equity, right? 4,000 million and each trading at 8.5. So just multiply and you are getting equity and debt. Asset beta, right? Let me check down how many steps are there. Yes. So asset beta, what is the formula? Please write the formula somewhere, or you can check the formula sheet. What is the formula for the cost of, for the equity beta? I'm sorry, for the asset beta, what is the formula? Right? I'm writing the formula here again so that right, asset beta is equal to equity beta multiplied by market value of equity divided by market value of equity plus debt, right? 1 minus tax. This is market value only. So this formula if you use, okay, this formula only they have used here. What is the equity? Cost of equity is 1.02. 1.02 is the cost of equity. Multiply by 34,000 because equity comes up. Market value of equity comes in the numerator. And then down 34,000 because cost of equity, market value of equity plus market value of debt. What is debt? Debt is 27,300 multiplied by 0.72 because after tax, you have deducted the tax 28%. So this is your asset beta. How will you know that your asset beta is correct or not? Always check your asset beta with your equity beta. Okay. Where should I write? Okay, I will write here only. Always asset beta will be less than equity beta. Always. Always your asset beta will be less than the equity beta. If it is not, redo the calculation. You are wrong somewhere. Always, you cannot question whether sometimes it will be a no. Your asset beta will always be less than your equity beta. Here your equity beta is 1.02 and your asset beta is 0.65. That means you are correct. It is less. It has to be less than 1.02. Right? Now let's go to the final part. You have the asset beta of both the companies. One has been given to you, one you have calculated. Now you can find the companies, combined companies asset beta. Right? So to find the combined companies asset beta, what do you need? What do you need to find the combined companies asset beta? First, you need to find the combined companies asset beta. How will you find companies asset beta? You have been given that it is the proportion to the market value of equity, right? So you know the asset beta. First, we'll start with Matt Trevor because it is given to you, right? So it's easy to work out. So this part, right? 0.75. Okay, just go to asset beta only. 0.75 because asset beta of Matt Trevor is 0.75 multiplied by 12,500 because the market value of equity is 12,500. You have to multiply by the market value of Matt Trevor, right? Plus, you have to take the Westphal cost of asset beta. Asset beta. Just now we have calculated as 0.65. Cost market value of equity is 34,000. Done. Divide the whole thing, right? Divide the whole thing by the addition of the equity of both. You are not taking debt because they told in proportion to the market value of equity, right? I will take you to that thing where they have mentioned that thing. Just read the first paragraph under post accusation cost of capital. Okay, so the asset beta post accusation can be assumed to be both companies' asset beta weighted in proportion to their current market value of equity, Add both the equities. That's it. That will be in the denominator. That's why you are taking 12,500 and 34,000. So this is your asset beta, combined asset beta. Now you are given the asset beta. Always asset beta is given, find the equity beta. If equity beta is given, find the asset beta. That's how you have to measure. Now asset beta is given. What is the next step? Always the next step after asset beta is to go to equity beta, because if you don't find the equity beta, you cannot use your capital asset pricing model to find the cost of equity. Right? It's very simple. You know that you have to find what? I will write here. Find cost of equity, no? To use in the CAPM, right? To use in, I'm sorry, not to use in CAPM. By using CAPM, you want to find the cost of equity. By. It's not to use, by using. So cost of equity, this word equity tells you that what you have to find? Equity beta. Equity goes with equity. Equity beta you have to find. And how will you find equity beta? By using asset beta, right? After asset beta, next comes equity beta. After equity beta, next comes cost of equity. After cost of equity, next comes cost of capital. This is the way. It's always this way only. Your question numbers will be different, the scenario will be different, but the pattern, the way it goes, it will be same. So next, go to equity beta. How will you find equity beta? Just I will take this formula only. Just see that this is asset beta is equal to equity beta into this thing, right? So now just rearrange, just reshuffle. We already have the asset beta, we want to find the equity beta. So it will be asset beta cross multiply. Okay, so your numerator comes in the denominator and denominator comes in the numerator, right? So basically this goes up, this comes down. So I'm not writing it again. So that's why asset beta 0.68, right? Multiply by equity plus debt. So equity is 34,000 and debt is 27,300 into 0.72, because after tax divide by market value of equity, which is 34,000. So this is your equity beta. Again, check whether your equity beta is greater than asset beta or not. It is greater. 1.07 is greater than 0.68. So you're right. Now what you have to do, use this equity beta in your CAPM model to find the cost of equity. Combined company's cost of equity. Right? You are not finding two different WACs, by the way. You are not finding two different cost of equity. The equity which you are finding is the combined company's cost of equity. You are already finding one asset beta for the combined company, one equity beta, one combined cost of equity, and one WACC only for the combined company. It's not two different now. It's one company. So, and they have told that the proportion of the combined companies, they have told that the proportion of the combined companies debt to equity is same as West Parless debt to equity. So that's why we are using the West Parless debt to equity only, which is 34 and 27,300. Now use this 1.07 multiply by 8, because 8 is the risk premium and 3.5% is the risk-free rate, and cost of equity is 12.1%. Now use that 12.1% in your to find the WACC. What is WACC? Cost of equity plus cost of debt. So let's go to the combined company's cost of capital. 34,000, because equity is 34, multiplied by cost of equity, right? Second portion deals with the debt. Debt is 27,300. Multiply by 9.87%, because they told that the pre-tax cost of debt for the combined company is 9.8%. So you have to adjust for tax. That's why multiply by 0.72. Divide the whole thing by the equity plus debt, right? 34 and 27. So you are getting 9.9. So you're rounding it to 10%. So 10% is your WACC. And this 10% only throughout the answer you have to use. So make sure that you are very accurate at this stage, because you will be using this answer throughout your answer. If this is wrong, all the other answers will be wrong depending on this. But your working has to be there. All the steps has to be there presented, not in your calculator or not inside your mind. It has to be written on the paper. Asset beta, equity beta, cost of equity, cost of capital. So combined cost of capital also we have found at 10%. Nothing to write, calculation only. Okay, let's find what is the third requirement. Third requirement is estimate the total value which West Parley Company shareholders will gain from the accusation of this one. So the total value which the shareholders will gain from the accusation, basically, right? So, and it's for 10 marks. That means you have many things to go there. So now Appendix 3. So Appendix 3 comes estimate of the value created for Westphal shareholder, right? Oh, it is repeated again. Okay. So cash flows from year 1 to 4. They have been given. Okay. Oh, we haven't gone through the case study of this, right? We have to go through the case study to find it out. Okay. So first we need this part, but then we'll also read this part as well. Plan for, because these are only the two last sections remaining there. Plan for the Matt Raver company. Okay. So the offer for this will be a cash offer, right? Any funding required for this offer will be a mixture of debt and equity, right? Mixture of debt and equity. Any funding required will be a mixture of debt and equity. Although for the purpose of calculation, it has been assumed that the overall mix of debt and equity will remain the same. Remain the same means even the post-acquisition debt and equity and Westphal debt and equity is same for the calculation, right? The directors are considering various plans for funding the purchase, which could result in a change in Westphal company's gearing, right? And you have seen that gearing is in your last requirement they are talking about, but it's okay. Anyway, we can read it because it's all theory, right? As soon as it acquires all of the Matt Raver company share capital, Westphal would sell Matt Raver stake as it does not. Okay, so after they acquire, what is the plan? Westphal is going to sell the tech as it does not fit in with the Westphal strategic plans, and Westphal wishes to take advantage of the large values currently attributed to the high technology business. In the beginning itself, we told that the high tech industry has been valued very highly. So what Westphal wants to do, they want to take the advantage of this high value. They want to sell it. If they sell it, they know they can get high values. They can sell at high values now. So they're selling. Okay, Matt Raver is into two part: Matt Raver Home and Matt Raver Tech. After taking over, Westphal will sell Matt Raver Tech. Matt Raver Home will be still there in the company. It will be retained. Right? When you read all those things, you have to understand what's happening. You have to make a picture. You have to imagine, make a imagination of what's happening. Where am I right now? Right? Where I'll be in the future? Where am I in the past? You have to imagine yourself as the one who's going to take over. Right? Always assume yourself from the point of the one who's going to acquire, the one who is going to take over. Right? So where have I been? Okay, so Westphal companies would then close the Matt River Homes worst performing city centers store. So first they will sell. Okay, sell this, close Matt River's worst performing city center stores. It anticipates the loss of returns from the stores would be partly compensated by high online sales by Matt Rivers Online. So they will compensate by high online sales by this one, generated by increased investment in its online operation. So they are also going to increase the online operation. And the remaining city center stores and all of the outtown stores would start selling food and household items. So the remaining city center stores and out of town, they will sell food and household items currently sold in Westphal stores. So they are currently today they are being selling in Westphal stores, but in the future after takeover they'll be selling the Matt Rivers city centers and out of town stores. The remaining they'll be selling few, the worst performing ones, but the good performing ones they will retain, and then they will sell their food and household items in those stores. Okay, and Westphal believes that this would increase profits from the stores, profit from those stores. Westphal also feels that reorganizing Matt Trevor's administrative functions, and using increased power as a large retailer can lead to synergies after the accusation. Now post-accusation detail comes. You need this piece of information. Okay, this requirement which I've just read now, you need it for the last requirement. Right? But it's okay. It's no harm that I finished reading it. It's good in fact. Okay. Post-accusation detail. Okay, so once the tech has been sold, they estimate that the sales revenue from the home stores will remain open together with the online sales from his home business will be this in the first year. Post-accusation. And this figure is expected to grow by 3% per year in year 2 to 4. Grow 3% per year in year 2 to 4. The sales value will increase. Okay. Profit margin before interest and tax is expected to be 6% of sales revenue in year 1 to 4. 6% of sales year 1 to 4. Tax allowable depreciation is assumed to be equivalent to the amount of investment needed to maintain existing operations. Right? So tax is assumed to be equivalent to the amount of investment needed to maintain existing operations. However, an investment in assets, including working capital, will be required of 613 year 1. 613 year 1. In year 2 to 4, investment in assets each year will be 0.5 of every $1 in increase in sales revenue. Understand this thing. They are not saying 0.5 of every sales. They are talking 0.5 of every $1 increase in sales of revenue. That means how much your sale is increasing from one year to the other. Only that change, you're taking 50% of that to find the investment in assets each year. Year 2 to 5. Okay, after 4 years, the annual growth rate of free cash flow is expected to be 2% for the foreseeable future. After 4 years, annual growth rate of free cash flow is expected to be 2% for foreseeable future. Right? As well as the free cash flows from this one, the West Parley expects that the post-tax synergies will arise from his planned reorganization in the next 3 years. So free cash flows, this, and this. Okay, and the current market value the current market value of the Matt Rivers share is 12,500 and debt is trading at his book value of 6,500. This we have been given before itself, before also. I've just repeated it. Right? Now we don't have any more to read. What we have to do is total value of how much they will gain from the accusation. Right? Now this is something which you need to think how to start. So first, if you want to start, right, they are basically asking you, they are saying it is a free cash flow, so that means you have to find the present value of free cash flow. So free cash flow is also like a cash flow, right? Make sure that you know free cash flow and free cash flow to equity. I have uploaded both the videos, you can go and check. I have explained what is a free cash flow, how to calculate. There is a method and it's different, okay, for free cash flow to equity and free cash flow. So this is just free cash flow, right? So free cash flow or cash flow, whenever you have to find the present value, here you have to find the present, okay? You have been given the free cash flow. So whenever you are finding and free cash flow, you know cash is there and you know that you have to find that value. So that means basically they are saying find the present value. And when you have to find the present value, it's like a table. You have to start for all the years, 1, 2, 3 and 4. So you know and you have an idea now that you have to start with a table, right? Cash flows. And here also doesn't matter when normal cash flow or free cash flow starts with sales. It starts with sales revenue. So sales revenue in the first year has been 43,260. This they keep on inflating 3% every year, right? Then let's go to profit before interest and tax. Profit before interest and tax. Profit is 6% of sales, right? 6% of each year, right? So 6% of 43,260 is 2,596. 6% of 44,558 is 2,673. Like that, every year you have to take. Then you have to deduct the tax. What is tax? Tax is 28% of this profit before interest. This amount you have to take 28%. And then comes the additional capital investment. Additional capital investment in the first year has been given at 630, but when you come to the 2, 3, and 4, you have to do a work. When you come to the second year, how do you find the additional capital investment? Just see from the first year to second year how much sales revenue has increased, right? So it is 44,558 minus 43,260, right? What is the difference? Let me also calculate. So it is 1298. The difference is 1298. Just take 50% of this. Okay, which is 649, which comes in the second year. Likewise, when you go to third year, this minus this, then this minus this, and take 50% of it, and you will get the additional capital investment and deduct it. Then, right, because your free cash flow, right, free cash flow is profit before interest and tax minus your additional capital investment. That is your free cash flow. Make sure that you know what is free cash flow first. Learn your knowledge. If you are not able to solve this, go back to free cash flow and see how I have done and calculated free cash flows. Then come and attempt this question. Then you will understand things better. Discount factor. Discount factor is 10%. Just now we have calculated combined cost of WACC. Right, this is after accusation. What is the value? So of course after accusation we'll be using the combined companies WACC, which is 10%. That's why I told you that you need the before answer, right? The previous requirements answer you need later. So 10%. So each year you are discounting at 10% and you are finding the present value of each, right? So when you add all from the first year to the fourth year, the present value is 4091. That's not it. You also have a growth factor, perpetuity, right? From 4 year onwards, from the fourth year to infinity. That's why you have to find this present value from year 5 onwards. Okay, so when it is a present value from year 5 onwards, what do you have to use first? Okay, you have to use this, not the present value but the free cash flow, 1353, right? So this 1353 you have to multiply by 2%, 1.02, because the rate of growth is 2%, right? Divide by, what is the cost of capital? WACC is 10%, right? Okay, 0.1, 10%, and growth is 2%, right? This you have to multiply by 0.683. You have to find the present value, right? 0.683. You have to find the present value. The fourth year, even though it's after 5 year onwards, you still have to use this year. You still have to use the last years always. Okay, it's not only for this, or always. Whenever you are given this perpetuity thing, growth after this year onwards, it keeps on growing. Always when you have to discount back, you have to find the present value, you have to use the discount factor of the last years. This is in this case the fourth year, so 0.683, right? That's why this or 0.683 is the same only. Put in your calculator and check. 1.10 to the power of -4. Make sure that you know how to use your calculator also, that you are able to put that -4, right, as a power of -4 on the top, right? Or another way of calculating this in your calculator could be 1 divided by 1.10 to the power of 4 will give you the same answer, right? and then you are getting the present value. Add this with this. From 1 to 4 and from 5 year onwards, add both the present value. That is your total present value. This is the total value, right? But that's not it. We also have to take synergies into account, right? For synergies, we have been given different free cash flows, right? We have been given 700, 750, 780. No need to adjust for tax. Already it is adjusted for tax. They told post tax synergies. Discount factor, even here it is 10%, right? So then you find the present value of cash flows, add all. So the present value of synergy is this, right? Now, what is the amount, right? That the amount payable for the Matt River shares. How much you are paying? You are paying a premium of 15%. I will take you there. In case if you forgot, because it is mentioned very early in the first part. Yes, here. Pay a premium of 15%. This one. Right? So they will pay a premium of 15%. So amount payable for the shares. Okay, this is the value of the shares, the equity at Matt River, which is 12,500. Right? That into 15%, right? 50% premium. So 1.15. Right? Because you want to find the amount payable for the Matt River shares. Now, this is the amount which you are going to pay for the shares, but what is the value of Matt Trevor? Just the individual company. You have to find the individual company value, right? So the value which is attributed to the Matt Trevor's investors is this. Okay, this plus 6,500. This 6,500 is your debt. Don't forget about the debt. There has been a debt also in Matt Trevor's company. So this is the total value of Matt Trevor. Now, just see what is the value attributed to the Westpale company shareholder, right? It is number 1, number 2, number 3, and number 4. 1 is the present value of cash flows, which is 15,872. It's here, right? Second, you are selling off the tech company. From there, you are receiving how much? For this, you have to go up, right? First, you are receiving present value from this, the free cash flow from this company, right? 15,872. You are receiving, you are selling tech. From there also you are receiving Westpale. For that we have to go up. Yes, exactly this one. Not this excess amount, okay? This excess amount we don't want. This is the amount. Proceed which you are receiving. That excess amount was just to compare. Okay, we are using that 5058. Because always what we do is whenever an answer is given at the end, we always take that answer only for our next calculation. So it is 5058. Number 2. Number 3, value of synergy. Just now we have calculated value of synergy. It is 1842 minus the value to the Matt Trevor company's investors. Why? Because you are paying Matt Trevor that much. That's a payment. So payment will go from your value. You are paying that to the Matt Trevor company. So that value will go to the Matt Trevor from the Westpale. So you have to deduct that. That's why it is 2875. Right? To find that value, you have to find the total value of Matt Trevor company's investor. That is your equity with the premium and your debt. So this is your value to the Westpale. Now, Since all this are done, okay, B part comes in the report. Now we can go and write the report because we are done with all the calculation. Right, just go. Yes, C part we'll do later. First we'll finish the report because C is not related to your report. C is another different thing. So now let's see how the report is formed. We have finished all the appendix, right? There has been 3 appendix, and you see that your appendix comes at the end. First comes your report, so now we'll go to the report, right? Just see the report very clearly. How many headings, subheadings they have used? Strategic fit, financial aspect, synergies, current Matt Trevor's home business, sale of the Matt Trevor's tech, other assumptions, conclusion. You have to include all these headings in your report, right? All these headings you will get from your requirements itself. Okay. And how will you get in order? I will, okay, first we'll go through this 3 lines, the first 3 lines. Those are your introduction, right? Report of the board of directors, West Pale company, right? Make sure that your introduction is very brief, to the point, and main thing you have to include in your introduction, what are you writing in the report. That's it. So let's read. This report evaluates whether the accusation would be beneficial to the West Palace shareholders by estimating the future value generated by the Matt Trevor's home currently. Matt Trevor's company, which is Matt Trevor's home currently. The proceed from selling Matt Trevor's tech and the additional value created from synergies immediately after the companies are combined. So that's it. Now let's go. Why strategic fit is there? Because let's go to the requirement and see. Right? Yes. Just go to the 4th point. Assess the strategic and the financial value to West Pale companies of the accusation, including a discussion of the estimations and the assumptions made. So strategic. So first you are starting with the strategic, number 1. Number 2, you are starting with the financial value, and for that financial value only you have to use all this 1, 2 and 3, right? All your financial aspects are those 3 only. You have calculated those before. So under your report, for the financial value section, you are going to write what all you have calculated in your first 3 parts. First, you are going to start with the strategic, because that is a theory part, right? You don't need any appendix or anything for that, so we can write strategic fit, divided into 2 paragraphs. Quickly we'll finish this, okay? So the strategic case for taking over the business appears to be the strongest for the out of the town stores and the online business. Okay, the accusation would provide an additional out of town presence for West Pale. This is all they have taken from the case, and it's your judgment how you use it, whether you fit it's a strategic fit or not, right? But just read the answer in case how it is presented. So better usage in the out of town stores could generate higher returns. Having food and home business on the same site could generate some cross sales between the two. So you're selling food and home from the West Pale also, from the Matt Trevor company also, so you can cross sell between the two. Possibly combining the two companies' online presence and investing further could mean they could benefit from the Matt Travers could benefit from the factor which have driven strong performance by West Pale. Taking over the city center stores, even the successful ones, seems to have less strategic logic, right? However, West Pale would be taking on a high cost burden. Exactly, if they're acquiring so much, it will be a high cost burden for West Pale. The success of the food business in city center is doubtful. Why? As food shops cited, they will be less convenient for customers who do not live in the city center. Yes, not all the customers live in the city center. So if you are building a city center, not all customers it will be convenient for. And West Pale has marketed itself as being easily accessible for customers. Remember I told you there was a logo Please highlight that logo. You need that logo for somewhere. Always whenever a slogan, a campaign, something has been promoted or something has been given, please highlight. You will need that piece of information somewhere in the answer, right? So here they have used it because they told in the slogan, we are there where our customers want us to be. That was their slogan. But here it does not look like, because every customer is not in the city center, right? So there is perhaps wider incompatibility between the two businesses, okay, between the Matt River and the West Valley. The food business is categorized by quick shopping for often a limited number of times, whereas purchases in the in-house business, particularly in larger items, are likely to take longer and site convenience be less of an issue. Now, this is nothing but your common sense only. How about food business is, how a large home business is. This is nothing which you need to think too much about it. We all know, we all are seeing how food business is. Everyone wants quick service. They don't have so much of patience. They don't have so much of time. Quick shopping, only for a limited number of items. You cannot sell all the items. Just look at McDonald's. McDonald's don't even keep those stocks where it takes more than 5 minutes for them to prepare. They only focus on those items where it's less than 5 minutes. That's why it is in number one position in the fast food retailer business. Customers don't have to wait quick, right? You go through that drive-in through. You order, while on the next station you are receiving the food. That's how efficient, that's how fast they are, because they know customers want quick service, especially when it comes in the food industry. But when it's for the home uh, business, it is not like that. Customers do not take quick decisions. It's a huge investment. They take a longer time to take a decision. So these are the ways how you interpret. This comes from your common sense, right? Everyone knows how food industry is, how furniture, when you go to furniture shop, you yourself see how you act in that situation and then use that in your answer. That's it. Now let's go to the financial aspect, right? So based on the predictions for the future cash flows and required premiums from the Matt Rivers shareholders, the accusation would add value to the West Paley company shareholder. Directly go to the point, okay? Accusation would add value to West Paley shareholder. Immediately start with that point only. Don't start writing synergies, this much, this is this much, this is that. Later you can nicely elaborate. Overall, what is your summary? What is your view? First line itself you have to say. There is not enough time you will get. You have to write most important points in the first line. Right? Don't write something which is not so important in the first and wait to write something which is very important at the end. Do the reverse of it. Okay? And how can they say? You tell me, how can you write this report if you haven't done the calculation part? Because if you don't do the calculation part, my dear, you will not know whether the value is adding or value is not adding, right? How they are saying that this will add value to the West Palace company shareholder? Because they have calculation, they have evidence, they have done the calculations, they have clearly seen that there's a value. So that's why now you can write that, right? You are not writing single line by line here. Synergy is this much, this is this much in order. No, that will do, but later, not so much. Just one line. Briefly, you have to write, summarize everything and write in the report. Right? So accusation would add value if and only if. So they are saying how it will add value. Excess value on selling Matt River's tech and the synergies are both largely achieved. So the synergy value has to be there and excess value on selling the tech. If this is large, okay, together they add up to. Let's see how much this both items together add up to, right? What was the excess value? In first requirement we calculated excess value was 558. And from selling the tech you are getting 1842. Just add both, you are getting 2400. Compared with the total value of 1897. What is this 1897? That is the last thing which we calculated, the value to the West Palace shareholder. This one. 1897. So the value is huge, right? Compare. The value is good, right? So there are questions about the estimates for this figure and also the estimates for the future free cash flows of the current home business. Always use this lines. Okay, I will put a bracket. This kind of sentences you have to use. Don't accept everything on the face value of it. Whenever some estimate is given to you, always write the sentence like there are questions about the estimates. We need to check more, right? This needs to be analyzed more. Sensitivity analysis needs to be carried to check the variation in the estimates. Such sentences has to be there in your report. Then only you can get good marks. Don't just accept everything as accurate, 100% accurate. You cannot be 100% sure, right? You're always in a place where you have to question. Just think like that when you go into the exam hall. Whenever you go to an AFM exam, always have this questioning ability, this mind of questioning mind. You're not there to accept everything on the face value of it and accept whatever is given to you, whatever the estimates. No, you have to say there are questions about the estimates. I questioned. Okay, it needs to be checked. The assumptions needs to be challenged. Such words has to be there. Okay, now let's go to the synergies. Yeah, synergies has to be there. Accusation means synergy has to be there. You have to talk about synergy. Okay, now let's see under synergy what they have written. Just see how many lines are there under each subheading. Under financial aspect there is 5 lines. Under synergy there is 5 lines. This is how your report has to be, not more than 5 lines. Again, I'm repeating, not more than 5 lines. It could be 1 line, it could be 2, 3, 4, 5, not more than that. Okay, so limit yourself to that. Most of the additional value is due to synergies, and it is difficult to see how synergies are calculated. Okay, there is likely to be scope for some administrative savings. However, operational cost synergies appear less obvious as the two companies are operating in different retail sector. Right? Any synergy figures will also have to take account of cost in achieving synergies. Okay, so they have to take account of cost in achieving synergy. Even if you are having a synergy benefit, there are cost. You have to take account of that cost of achieving synergies. Okay, such as what are the cost of achieving synergies? There are some costs, right? You have given up somewhere. The benefit has been given up on some places so that you can get the benefit of synergy. So that some things which you have lost the value, the benefits which you have given up to gain a synergy benefit, you need to calculate those, such as store closure cost. You are closing some stores and there are costs for closing those stores. And also commitments such as leases, which may also be a burden for some time. Yeah, you may be taking leases if you have to go for a store. You're not purchasing a store outright, right? On a land, will be taking leases if you want to expand, which may also be a burden for some time. Synergies may also not be achieved because of lack of quantitative is good. You have done financial, but don't always stick into one thing. Okay, financial values, numbers and all. Try to bring more qualitative factors also into account. Your answer have to be balanced of both financial values and qualitative values, right? So synergies may also not be achieved. Why? Lack of operation by the staff or problems integrating the two business. The culture of the two business will be different. It's difficult to integrate culture, right? Now let's go to the next. What is the current Pat Trevor's home business, right? They're talking about the home business. And it's just 5 lines, right? Even though so many calculations are there, but when it comes to a report, it's very, very briefly written, right? They're not including everything. I have done this calculation, this is the synergy, this is this. No. Only some numbers you're using from there. So current Matt Trevor's home business. Now the suggested increase in cash flow appears doubtful for a number of reasons. See the words they're using. Even your answer has to include such words, right? They told that there's an increase in cash flow. It appears doubtful for a number of reasons. Let's see what are the reasons. If stores being closed are making positive cash flow contributions, they will have to be replaced. This will have to be replaced. Okay, whether they can be is a doubtful given the problem in this first part of the retail sector, right? It may be a more profitable use of store space to have an area for food sales, but the food sales generated in Matt Traver's company shops may take business from Westpale's existing shops. See, already Westpal is selling food in their existing shops, right? If now they're using the stores of the Matt Travers also to sell the food, and if that becomes more profitable, it will take over the Westpal's business, right? Matt Travers will take over the Westpal's business, the food business. Similarly, increased online sales may be at the expense of sales in stores. Yes, it's true that online sales is increasing, but what are you giving up for? What are you losing? You are losing the sales in stores because you're selling off stores, right? Now let's go to the sale of the tech. Okay. So there is no indication of how interested buyers will be in the business. No indication. Exactly. They're just saying that they're going to sell. But what about the buyers? From the buyer's perspective, are they interested in buying it? It's not given there, right? There's no indication. The industry's price earning ratio used, which is 18, by the way, right, may be an average which does not reflect Matt Trevor's tax circumstances. Maybe it's an average PE ratio. It's not necessary that it will reflect the Matt Trevor's tax circumstances, right? It would be better to find a PE ratio for a proxy company with a similar financial and business risk. Now you're also giving some recommendation what it needs to do. So they are saying to find a PE ratio for a proxy company, right, with a similar financial and business risk, right? Some company which is similar to Matt Raver's Tech, right? A company which is similar to Matt Raver's Tech business in terms of the financial and the business risk, then it's better to use that company as a proxy to find the PE ratio rather than using an average PE ratio of an industry. As Matt Raver's Techs would not be listed, right? They didn't say whether this is listed or not. This would suggest a discount to the PE ratio should be applied. What does it mean? It means that a PE ratio of unlisted company will always be less than the PE ratio of listed company, right? PE ratio is 18 in this case, but if it's unlisted, it will be less than 18. That's why that means that's what it means by a discount to PE ratio if it's not listed. So since also Westpale has an estimate of future free cash flow, right? They have an estimate. What is the future free cash flow? Potential buyers may be able to come up with their own estimates and base the price they are prepared to pay on their estimates. Other assumptions, right? So what are the other assumptions? One important assumption is the 15% premium expected to be required by the shareholder, right? Other assumptions made in the calculations including operate profit margin and tax rates remaining constant and cash flows being assumed to increase to perpetuity. So they told that cash flows will increase to perpetuity. It has been assumed, and also Profit margin and tax rates will be remaining constant in all the years. These are all assumptions. Incremental capital investment is assumed to be accurate, right? It is assumed to be accurate. Incremental. It is assumed that the cost of debt will remain unchanged. And asset beta, cost of equity, cost of debt can be determined accurately. You have to mention this whenever you are using this kind of information where you using asset beta, cost of equity, cost of debt. Just write under the assumption that it is determined to be accurate, right? Given all the assumptions, given all the assumptions, Westphalia's company should carry out sensitivity analysis using different assumptions and obtaining a range of values, right? So, should carry out sensitivity analysis using different assumptions and obtaining a range of values. Always your final recommendation, this thing has to be this. They have to talk about sensitivity analysis, right? So always mention about sensitivity analysis. Just say that it's better to go for a sensitivity analysis using different assumptions to obtain a range of value. It's better to take a decision when there's a range of values rather than just taking decision based on one value only. And finally comes the conclusion. Here I just want to take a 2 minutes break. So I will come after 2 minutes, right? Okay, I'm back. Let's resume to conclusion. Okay, so on the assumptions made, okay, the accusation appears to add financial value for the shareholders of Westpale. However, the figures are subject to a significant number of uncertainties, okay, and the strategic logic for buying the whole Matt Java business appears unclear. On balance, Westpale may want to consider a more limited accusation of just the out-of-town stores if these are available, as their accusation appears to make better strategic sense. Right? Try to use these words when you're writing conclusion on the assumptions made. This accusation appears to add, right, financial value, but they're talking about the strategic value. They're saying that rather than buying the whole, it's better only to buy the out of the town stores, right? And the figures are also subject to uncertainties. So all those things you have to, you can include in your conclusion. Now let's go to the last part of this, which is part C, right? Where they talked about discuss factors which they determine how the offer will be financed and has a level of gearing for 8 marks. So they have used 4 things. It will be for 2 marks each. They have talked about director's preference, cost and the cash flows, the availability of the finance, and the mix of the finance. But before that, first they talked about the calculation of gearing, right? So let's read. And I'll be a little quick because then this video will be too long. Okay, I just want to finish it in 2 hours. So I will just rush through, right? If getting is calculated on the basis of market value, a fall in the share price will result in the level of gearing rising. Okay. Westpale boards may be worried about a fall in the share price given the problems affecting many company share prices in the retail sector. It has been told in the beginning of the case study that the retail sector share prices are not doing well, and the possibility that the stock market may react adversely to the accusation. Now let's go to the director's preference. So first factor which is going to affect the way it is financed is director's preference. Directors may have their own preference about financing. They may be able to choose a mix of sources and a level of gearing which reflects this preference. Directors may be concerned about too high a burden of payment to finance providers in terms of cost or ultimately repayment of debt. They may not wish to commit the company to conditions imposed by finance providers. By contrast, they may be concerned about how a change in the shareholder base as a result of the share issue may impact upon their own position. Directors may also be concerned about the impression given by their choice of finance. Pecking order theory. So they have talked about, okay, whenever you're given this, try to mention this when they're talking about the way how an accusation is going to finance, right? Or whether it's better to finance through equity or debt, you can mention about pecking order theory, okay, where it states that the equity issue is seen as the last resort for financing. So if the purchase is financed by an equity issue, it may be seen as a sign of lack of confidence by the directors. Okay, so equity issue, it is seen as a sign of lack of confidence by directors that Westpale can sustain its current share price. Okay, why? Because equity is the last resort. That means what happens if you go by the equity issue? The market assumes, right? The market judges that your retained finance, right? Your retained earnings is over, your debt is over. So now you don't have enough. So now you are going for the equity issue, which is not good. Now let's go to the cost and cash flows, the cost of the finance. Gearing decisions may not just be determined by their own preference, but by the external conditions or constraints. Choosing more debt could lower the overall cost of capital. We all know that more debt is better because tax deductible, right? Due to lower cost and tax relief. Making investments such as this one appear more profitable. High levels of debt may result in the cost of equity rising, reducing the overall impact on the cost of capital. Again, Against that, higher levels of debt means increased finance cost commitments, right? Even though debt is increasing, still you have to pay interest, higher interest also. Even though Westphal may need further cash for investment in stores, this may be an important concern if interest rates are high. By contrast, dividends to shareholders do not have to be paid, right? Interest has to be paid irrespective of what your company's performance is, but dividends to shareholders should not be paid. Okay, you can avoid to pay it when returns are low or money is required for investment, although failure to meet dividend expectations may result in the board being pressurized by shareholders. Now let's go to the availability. Okay, availability. The availability of finance may also be a significant issue, whether it is available or not, the finance, right? Particularly if an accusation has to be completed quickly. An equity issue may take time to arrange and require shareholder approval. Yes, it's not easy to go for an equity issue. You need to take the consent of all the shareholder needs to approve, and also it takes time to arrange equity rather than debt. Sufficient debt finance may be difficult to obtain if lenders feel that West Parle already has significant commitments to debt finance providers, right? If already so much of debt is taken, it's difficult to extend more debt. So the time scale over which finance is available may be significant. West Parle may seek longer term finance if existing debt finance is due to be repaid soon, or if significant cash is needed for the short term investment, not just in this store but also in West Parle's existing stores. Now mix. Okay. Other external factors may influence the mix of finance chosen. The director may be concerned about keeping the level of gearing at or below the industry average because of finance providers becoming worried if gearing exists industry levels. Yes, if your gearing exists industry levels, finance providers they become worried. It's a sign of tension. Keeping debt as a significant element in overall finance may act as a deterrent to acquirers becoming interested in making a bid for West Parliament. Right? Directors may also not have a target figure in mind, but be content if gearing is within a range of values. Right? So that means they are saying that if you're having a large portion of debt in the overall finance, they will not think about taking a target, they will not think about taking over a company because their main impact is to keep the level of gearing at a level. That is their main concern. So that's it. These are the 4 factors which has been described for part C, the last part. And one thing, I overall we are done with the paper 2000 March 2020 paper. I will take just 5 minutes to go through the marking scheme because many of you don't bother so much about the way it is marked. Only you just check the answer. So this all question 1, 2 and 3 is been given and we'll see how it is marked. Okay. So first question is about behavioral finance, right? Factors. So 1 to 2 marks per relevant point. These are the examples: asking price, opportunity to purchase, information available, positive, herd instinct, following fashion, confirmation bias. So all the 6 points, right? You'll be getting 1 marks, or if you're writing 3 points and explaining them in detail, you'll be getting 2 marks, right? Now let's see the second part. Second part is just the comparison of the two, and it's for 4 marks. So just see how it is marked. Share of pre-tax profit for the tech is 1 mark, after tax 1 mark, proceed from sale of is 1 mark, and comparison with the free cash flow is 1 mark. Third is about combined cost of capital, 6 marks, right? 1 mark for it. Just see how you can lose 1 mark just by missing one step. Each step is very important. This is what I wanted to show you, right? So West, even finding the market value of debt and equity is 1 mark for West Parle. West Parle's asset beta 1 mark, combined companies asset beta 1 mark, equity beta 1 mark, cost of equity 1 mark, cost of capital 1 mark. Each step needs to be shown. Then let's go to the value for the shareholder, West Parle shareholder. First, sales revenue we have calculated, just 1 mark. Profit before interest and tax. So you cannot miss even one line, right? Profit before interest and tax. Tax itself is 1 mark. Additional capital investment 1 mark. Present value from 1 to 4 1 mark. Present value from year 5 onwards is 2 marks because you need to do additional calculation there. Present value of synergies is 1 mark. Premium payable is 1 mark. And value final is 1 mark. This is how you're getting the 10 marks. Now let's go how the report is, right? Strategic value 3 to 4 marks. That means 3 to 4 points you have to tell under strategic value. Financial value, again 2 to 3. Estimation, okay. Estimations made is 3 to 4 marks. Just imagine if you didn't write your assumptions or estimations. Just focus only on strategic and financial. You will be losing for around 6 to 8 marks. So estimations also 3 to 4. Assumptions is also 3 to 4. And finally, the report. The one is the report format. The second is the structure, and the presentation is itself is 3 marks. And finally, the C part, which is about the way it is financed. Okay, so security, tax relief, shareholder attitude to debt, all those. Now let's go to the second question, which talked about hedging, right? And first question was about rationale and communication. So 3 to 4 marks for reasons for hedging, and 3 to 4 for the communication of the policy with the stakeholders. Second part, where we have to go through forward options and future. Just see, each one is 1 mark. Forward is 1 mark. Buying September future, you have to say that you are buying September future, will give you 1 mark. Calculating contract will give you 1 mark. Closing future rate, 1 mark. Under hedged futures, which you are covering through forward, is 1 mark. Buying September call option, 1 mark. Option premium is 1 mark. Future outcome, right, is 1 mark. And the total outcome and the discussion and the recommendation is 2 to 3 marks. You see, more marks is there in your discussion and recommendation than the calculation. So you cannot leave your discussion and recommendation. Then let's go to C. Initial or maintenance margin is just 1 mark. Daily profit or loss for calculations is 3 marks because it's for 3 different days. And explanation is again 3 marks. Let's go to the third question, net present value, right? Contribution, 2 marks. Fixed cost, 1 mark because it's very simple, right? Tax is again 2 marks. Net present value is 1 mark. Your expected net present value is 2 marks. Your alternative option net present value is 2 marks. Decision outcome is 1 mark. And your decision is 2 marks. Comment is 4 marks, right? So don't ever miss out your comments. When they tell that comments on your finding, comment on your analysis, you have to comment. Right? And finally, the last part, capital investment monitoring, the rationale and the benefits, right? 2 to 3 marks. Even for the post-completion audit, 2 and 2 to 3 marks for the rationale and benefit. So this is, it's, if you see the marks, the way the marks are divided is always equal. It's always equal, right? So if you're given 2 requirements under 1 and it's for 8 marks, it's very easy to say that 4 marks for each requirements, right? 4 for reasons, 4 for benefits. So like that, you have to divide your marks with the requirements. So that's it. This is the marking scheme. Okay, and you can download this paper in the link below. So if, the link in my description will be given to you so that you can access this paper, both the marking scheme and the question paper. And that's it. Hope you do all the very best. I have given you all the techniques for the AFM. I will not be giving you any more. I will not be doing any more paper, and I will not be giving you any more techniques for AFM. I've already given you enough. Now we'll meet at live on 1st of December. Don't forget, tell your friends and tell everyone. So on 1st of December, we'll be meeting on live, and there you can live. Okay, you can discuss your issues. You can ask me any questions. I'll be answering about AFM, any paper. And that's it for AFM. Best of luck. Wish you all the best. Take care.